3 ETFs, over $3.3 trillion in combined assets. Millions of investors think they're building the perfect portfolio. But here's what Vanguard doesn't advertise. These funds are designed to make you think you're diversified when you're actually not. I'm about to expose the marketing trick that's hiding in plain sight, show you exactly how fund companies profit from your confusion, and reveal why Harry's safe strategy nearly cost him his retirement income. Today we're pulling back the curtain on VTI, VOO, and VGT. 3 funds that generate billions in fees while delivering something completely different than what their names suggest. I'll show you the mathematical proof that these aren't 3 different investments, reveal the sector classification loophole that's costing investors millions, and give you the insider knowledge to build a portfolio that actually works for passive income. Plus, I'll reveal the one chart that changed everything about how I view ETF investing forever. Educational disclaimer: this video is for informational and educational purposes only. It is not financial advice. Meet Harry, a 35-year-old software engineer earning $75,000. Like millions of investors, he believed the marketing messages. Total stock market for diversification, S&P 500 for stability, technology for growth. Harry thought he was being smart. 3 different ETFs, 3 different strategies, perfect dividend investing balance. Then, Harry discovered something that made him question everything he thought he knew about financial independence investing. The fund companies weren't lying to him. They were just being very, very clever about what they chose to emphasize. Here's what the marketing materials tell you about VTI. Broad exposure to the entire US equity market. Sounds amazing, right? YTD return, 10.60%. Dividend yield, 1.28%. 3,561 stocks for maximum diversification. I used seekingalpha.com to pull together all the performance data for this analysis. There's an affiliate link in the description if you'd like to check it out. But here's what they don't emphasize. Market cap weighting means you're not actually buying 3,561 equal pieces. You're buying a large cap fund with 3,000 tiny companies attached. The top 10 holdings control 31.21% of the fund. Microsoft alone gets 6.01% of every dollar you invest. So when you think you're buying the total market, you're really buying the same mega-cap stocks that dominate every other fund. The expense ratio is just 0.03%, which sounds great until you realize you're paying for diversification you're not actually getting. Harry spent months researching small-cap growth potential, thinking VTI would give him exposure to the next Amazon. Instead, he got a fund that moves almost exactly like the S&P 500. Why don't they tell you this up front? Because large cap weighted index with small cap flavoring doesn't sound as appealing as total stock market. But wait until you see what they've done to the S&P 500 itself. Now let's talk about what they do tell you about VOO. Tracks the S&P 500. Straightforward, honest marketing. YTD return, 10.58%, dividend yield, 1.27%, 509 holdings with rock bottom 0.003% expense ratio. But here's the part they whisper: this isn't your grandfather's S&P 500. The index has been completely transformed by the addition of today's mega-cap tech companies. The top 10 holdings now control 35.79% of the entire index. Just 3 companies, Microsoft, Nvidia, and Apple, represent nearly 20% of your investment. When you buy 500 companies, you're really buying a concentrated bet on a handful of tech giants. Amazon was added in 2005, Google in 2006, Meta in 2013, Tesla in 2020. Each addition fundamentally changed what the S&P 500 represents. Here's the kicker. The dividend growth of 7.92% 3-year CAGR is impressive, but it's coming from companies that prioritize share buybacks over traditional dividend investing principles. Harry realized he wasn't buying America's 500 largest companies. He was buying America's 500 largest companies, heavily weighted toward the 10 that happened to grow the fastest in the last decade. Speaking of concentration, wait until you see what they call diversified technology. Now for the biggest marketing trick of all, VGT, the Information Technology ETF. YTD return, 11.99%, but dividend yield drops to just 0.51%. The expense ratio jumps to 0.09% for 322 stocks. Here's what they loudly advertise. 479.30% returns over 10 years. Nearly 480% gains. Who wouldn't want technology exposure? Here's what they quietly mention in the fine print. The top 10 holdings control 59.19% of the fund. Microsoft, Nvidia, and Apple alone represent 45% of your investment. This isn't technology diversification. It's a leveraged bet on 3 companies. But wait, it gets worse. VGT doesn't include Google, Amazon, or Meta. Why? Because of GICS sector classifications. Google and Meta are filed under communication services. Amazon is consumer discretionary. So this technology fund misses some of the world's largest technology companies because of bureaucratic categorization rules. If this is blowing your mind, smash that like button, because what I'm about to show you next will change how you see index investing forever. The dividend growth tells the real story. Just 2.34% 3-year KGR. These companies don't pay you to own them. They expect you to bet on price appreciation. Harry thought he was buying diversified tech exposure. Instead, he bought a fund where nearly half his money went to 3 stocks he already owned through his other ETFs. But here's where Harry's story gets really shocking, when he discovered what he actually owned across all 3 funds. Here's where Harry's story gets interesting. He decided to actually calculate what he owned across all 3 funds. Using overlap analysis tools, Harry discovered the shocking truth. VTI and VOO share 497 holdings with 86% weight overlap. For every dollar Harry put in VTI, 86 cents was invested in identical S&P 500 companies. VTI and VGT overlap by 29.7% weight, exactly VTI's allocation to technology. VOO and VGT overlap by 31.5% weight, exactly VOO's tech sector allocation. Harry wasn't building a diversified portfolio. He was buying the same companies 3 different ways, paying 3 different expense ratios, and calling it diversification. His effective allocation to Apple, Microsoft, and Nvidia exceeded 25% of his total portfolio. One bad earnings report from any of these companies would crater his diversified investment. The fund companies didn't hide this information. They just made it really hard to find and understand. Next up, the macroeconomic truth that changes everything about these returns. Now here's the context that changes everything. VGT's incredible 479% decade of returns coincided perfectly with the most accommodative monetary policy in U.S. history. From 2008 to 2021, interest rates were essentially zero. Growth stocks like those in VGT thrived because future earnings were worth more when discount rates were low. But we're in a completely different world now. Rates have moved from near zero to over 5%. This fundamentally changes how growth stocks are valued. Growth stocks depend on future earnings potential. When rates rise, those future earnings become less valuable today. Companies with strong current dividend yields and cash flows become relatively more attractive. Harry realized his original strategy was essentially a bet that the 2010s would repeat forever. The marketing materials never mentioned that VGT's performance was tied to a specific macroeconomic environment. This is why understanding what you actually own matters more than past performance charts. But wait, there's something even more costly that Harry discovered. The 3 hidden costs. Let me reveal the 3 costs that Vanguard doesn't advertise. Hidden cost. Number 1, redundancy tax. When Harry bought all 3 ETFs, he paid 3 sets of expense ratios for essentially the same holdings. That's 0.09% extra annually for redundancy. Hidden cost. Number 2, concentration risk. Harry's diversified portfolio had 45% exposure to just 3 companies. One sector rotation could wipe out years of gains. Hidden cost. Number 3, opportunity cost. By overweighting megacap tech through redundant holdings, Harry missed allocation opportunities to REITs, international markets, or value stocks that might complement his core holdings. The real kicker? Harry's strategy delivered lower dividend income than a simple 100% VOO approach, while taking on significantly more concentration risk. Here's the strategy that changed everything for Harry. After discovering the truth, Harry completely reconstructed his approach. Instead of falling for the marketing complexity, he embraced mathematical simplicity. Harry's new strategy: 100% VO, $1,000 monthly investment. After 10 years, $289,800 estimated portfolio value. Annual dividend income, $3,400, return, 141.5%. Why this worked better? Zero redundancy. He knew exactly what he owned. Optimal dividend yield at 1.27%. Dividend growth of 7.92% annually. Eliminated sector classification confusion. Reduced concentration risk while maintaining growth exposure. The beautiful irony? By buying one fund instead of three, Harry got better diversification, higher passive income, and lower costs. Sometimes the simplest solution is the most sophisticated. Now here's the secret about diversification that fund companies hope you never learn. Real diversification isn't collecting ETFs with different names. It's understanding underlying exposures. If Harry wanted tech beyond VOO's 31.5% allocation, buying VGT was amplification, not diversification. True diversification means adding REITs, international ETFs, or value funds. Warren Buffett: diversification is protection against ignorance. Fund companies profit when you don't understand this. Here's another hidden cost. When companies join major indexes, ETF investors pay inflated prices. Tesla's 2020 S&P 500 edition saw the stock surge 70% before inclusion, forcing index funds to buy at peaks. Harry realized he was paying for the privilege of buying stocks at the worst times. The biggest truth about Vanguard's most popular ETFs? There are 3 different ways to buy the same companies with different marketing spin. Harry's transformation wasn't finding the perfect portfolio. It was understanding that simple beats complex. The path to financial independence isn't collecting ETFs like trophies. Your retirement income depends on informed decisions, not sophisticated marketing. Which approach resonates with your dividend investing goals? Subscribe for more real passive income strategies without the marketing noise. Investment risk. Notice, all investments carry risk. Past performance is not indicative of future results. Always do your own research or consult a professional.